Rick A asked a question. He said, if there's time to cover any best practices for zero DTE spreads, debit versus credit, pros and cons, thank you. All right. Before we jump into this discussion, Rick, I want to go over to our YouTube channel very quickly. And what I'm going to do on the PowerOptions YouTube channel, you can see your listing of different videos here, but I'm going to use the search tool, the little magnifying glass here on our videos, and I'm going to go, I don't know if I want to type 0 or 0 outright, but we're going to try 0 DTE. I might just want to search for DTE and see what comes up. Okay, so what we have here first, Rick, is setting up a 0 days to expiration search using the tools. 0 days to expiration iron condors. There's some discussion there. Here's one on the poor man's covered call. Gentleman wanted to ask about using calendar spreads. The poor man's covered call for 0 days to expiration on the sell option. I don't think I necessarily recommend that one, Rick, and I know that's not related to your question. But there's other discussions here, and I think it's this one, 0 days to expiration iron condors, where we actually discussed it, and I held off posting. Oh no, Rick, we're gonna talk about it too. Don't worry, but we're gonna talk about it right now, Rick. But these are just some other concepts. But I think on this one, the 0 days to expiration iron condors, if I'm not mistaken, from a year ago, we actually had the presentation, and then I went through the next week and traded the criteria that we had for the 0 days to expiration iron condors. This was about a year ago. This was last August. Got to be honest with you, there is about a 50-50 win-loss ratio on that position. The losses weren't extravagant, though. They weren't terrible. It just wasn't a profit, and it had to be managed. So it didn't work out to the expectation. I think directional, as you mentioned, credit or debit spreads might be better. Personal preference, Rick. And many of you that have been to my webinars before, I always prefer to use a credit spread over a debit spread when I'm going shorter term. And what I mean by that, Rick, is that when I'm looking for minimum net credit, my preferred bullput credit spread search, what I use for my criteria, the weekly bull puts here, 14 days out in time. Okay, Rick, but usually I'm opening them on Monday, so it's really 11 days out in time. I want the shorter time frame, but all of my testing showed that the criteria that I set up for the 2 weeks, trying to develop it into a 1 week trade or 30-day trade, the 2 week out actually performed better. And it's because you get a little bit better net credit, you're a little bit further out of the money, you weren't getting stops triggered as much. And by the way, this testing for me for the bull puts was done starting back in 2016, 2017, and moving forward there. So short term, 0 days to expiration, weekly spreads, 2 week out spreads. I'd prefer personally to do a credit spread, looking for a high probability of expiring worthless, looking for a good net credit. I'm targeting around 17, 18, or 16 or 17%. The average win for me is about 15.9%, about 86, 87% of the time, and keeping losses to about 50%, the remaining 10, 12, 15% of the time. Okay. So that's what I target with my bull puts. And when I think of 0 days to expiration, as you saw with some of those videos that I posted there, I'm looking to do, if I'm doing a 0 day to expiration, it's going to be a credit spread. It's going to be an iron condor. The bid-ask spread on in-the-money debit spreads, where I'd want that high probability, even on the shorter term, is going to be too wide. I'm not going to get potentially the fill that I want, is what I found. And that's why I prefer the credit spreads on the shorter term. Okay. All right. He says, I do prefer credit spreads also, but if I look at least 2 to 3 weeks out with so much variance, everything seems to fail. Okay. Well, there are black swan events. Okay. There are things that happen. We'll talk about that later. I'm going to talk about this criteria later, Rick. I'm going to save that comment. Okay. And you said, if I can be more specific, I try to be accurate on expected move based on IV. I don't personally think that's the right approach for 0 day to expiration spreads. Now, I could be wrong. I'm going to have to do another test for you too, Rick. Probably take me 2 to 3 weeks. But Here's the deal. What is everyone trying to do? Everyone, of course, is trying to time the market on a daily basis. Many of you that have been on webinars with me before, you know that we have discussed the market sentiment tool, how we use that to identify positions, how we use that to identify market trends. And here on the market sentiment tool, what is the market sentiment tool? Well, it's a collection of 13 broad-based indicators that Ernie tested and set up. He went through about 40 to 50 different indicators, and these were the ones that he found out pointed to a change in the market. Not daily, not tomorrow morning, not anything of that nature, but based on historical trends, when the market is overextended, there are fences set for each of these. Put call volume ratio, you can see it's almost going into a bearish mode right now. So is the SPX gap over the SMA 20. Where are we close on other ones? We're in bearish on the MACD gap for S&P 500. So what does that mean? Well, when you get a certain number of these different criteria that go into the fences of buy or sell, it triggers the buy or sell warnings. So back on July 12th, July 11th, we were in sell warnings, but July 11th and July 12th, we went into the bearish sell warnings. That's way down here in this time frame. And we were peaked out at 5,600. And what happened in the next 5-6 days and 10 days going forward? Dropped down to about 5,200 on the SPX. What did I do at this time? I protected my bull put credit spread portion of my portfolio, Rick. Well, I closed some of them. I lightened up. If I was doing 0 days to expirations when I saw these 2 bearish sell warnings in a row, I would have been doing bear call credit spreads on SPX, NDX, things of that nature. What I did, though, is I bought calls on VIX as a broad hedge. VIX was at 1250. I bought the August. They would have expired today, but I closed all of them out. They were the August 23rd 16 strike for 85 cents a piece on July 12th. I'm sorry, not the 23rd, the 21st, the Wednesday. Sorry. In any case, that's what I bought. And then when we started to see the bullish buy warnings down here, we had closed half at this point for about 100% profit. We closed the next half at this point for about a 500 profit, and the last 2 or 3 remaining 2 calls, on the VIX Rick here was about a 30% profit. That was just a hedge for that speculative portion of my portfolio. I could have bought puts on SPY at the same time, and that's what I would have done. Then we see the bullish buys. What did we start doing? We started jumping back in on 8.5, back into bull put credit spreads, 2-month out at the money bull call debit spreads, farther time at there as well. You know, the at the money ones that have a 1-to-1 risk reward ratio, Rick, instead of the 85%, which looks like a 10-to-1 risk reward ratio. But we followed it at that point and entered new married put positions as well for the longer term. And here we are. Now we're still at neutral, but you can see historically when the bullish buy signals are triggered versus the bearish sell here on the market sentiment tool, what that means, what we look for, and how we manage positions in that case. I'm just pointing this out because it's not morning to morning. Okay, this is updated at the end of day. It hasn't even updated yet. As you can see, we're still on August 22nd. It's going to update probably at around 5 o'clock. We'll take a look at that at that point. 4:45 is what Greg usually says, our head programmer and CFO. But it's not updated yet. But in any case, I know where I'm going with this, Rick, is I know that a lot of people that teach the 0 days to expiration spreads come out and say, oh, our signals are saying that SPX is going to be up tomorrow, so we're going to enter a bull put credit spread tomorrow morning as soon as the market opens. Usually when the market opens, it's already starting to go up. What I prefer to do and what I did in that other test, same thing I would do with my bull put credit spreads, I'm almost going to wait till 10 o'clock. Okay, maybe 9:45, 10 o'clock, 10:15 to see what the market's doing. Even though I missed the movement, Rick, I want to see the direction the market's heading and what's going on. Things that can change that you have to be wary of, by the way, we saw last week. There were a lot of economic reports that came out. This week we had Powell speaking, of course, but last week or 2 weeks ago, I'm sorry if it was, you had Powell speaking again, doing other things, and then we had the reports coming out at the retail sales and jobless claims, and then the jobless claims were adjusted this week, or was it last week? It was this week for the last, all those things. Why is that important? Because that can change the afternoon mix. I mean, this is the first time I've had to ever, the last 3 years, 2.5 years, Rick, is the only time I'd have to say, no, we actually have to pay attention to this Tuesday, Wednesday, Thursday meeting of the Fed and when Powell talks, because especially in 2021, I believe it was, or 2022, I think it was, he says he's going to do something, the market drops 3 or 4%. He does it the next day, and the market goes back up 2.5%, 3.5%. It's almost right back to where it was. It was very bizarre, and it was hard to play, and I was trying to avoid any shorter-term weekly trades or things of that nature. Implied volatility does not necessarily give you, where I'm going with this, by the way, Eric, I apologize, but implied volatility does not necessarily give you a direct gauge of what's going to happen in the morning, because any news can happen between when we start trading at 3:58, 3:59 to 8 o'clock in the morning, 9 o'clock in the morning. Implied volatility is saying, oh, maybe something's on the horizon. Interestingly enough, we kept seeing the VIX go up the past 2 days while the market was going up. This is the first day it's actually dropped as the market went up. So that would, to me, was an indicator too of maybe something was going on, because this was staying up at 17, 18 while we were getting back up to 56, 34 and wherever we are in the NASDAQ right now. All right. But the case is, I would wait. If I'm doing 0 days to expiration, let's say I'm bullish, or I think I'm still neutral here. We've been on a bullish trend. Market sentiment still telling me neutral. Clear filters here. Actually, I think I have a default search. OTM spread. SPX 0 day. Let's take a look. We're not going to find any. Why? Because the next options are on Monday. Let's put that out to 4 days there. There we go. All right. So what am I still looking for in this credit spread search? I'm just looking against SPX. We're looking at the 26th of August, 3 days away. That's Monday. But this search, all expirations, blank to 2, as you saw, Rick, which is what I normally use. On Monday, I would run this search, and I'm looking for similar criteria. Now, I'm only looking for a minimum net credit of 2 cents. I want a return of at least 1%. This option bid of 1 cent, Rick, is just to make sure that I don't have a wide bid-ask spread. I'm also using the bid-ask spread limitations here for percent bid-ask spread or monetary bid-ask spread. You could use that as well. And I still want the 80% probability. Now that gets tricky with the daily options because it's using, the 20-day volatility, the 20-day implied volatility, and the SIV of the options to say, hey, what is the likelihood based on what it's done that it's going to do this? But I'm not trying to place the trade on Friday for Monday. I'm not trying to place the trade Monday at 3:58 for Tuesday's open. I'm not trying to time the market. With a 0 day to expiration spread, in my opinion, I'm waiting for the market to do its thing in that first 15, 20, 30 minutes. And then I'm going to say, okay, what are the bear call spreads I want if the market's down? What are the bull put credit spreads that I want if the market's up? All right. And that's what I'm going to look for in that case. Now, you notice here, the basic search criteria I have, it's just looking at options criteria. That's all I'm doing. Basic option volume, basic open interest. As I mentioned, limit the bid-ask spread. Still looking for the good probability of 80%. Do the returns make sense? Well, these are 3 days out in time. So we're at 8.1, 7.2. Put on your daily spread, that's going to be much lower. And now I can't give you a good example of this. I'm jotting this down as we're talking. I'm sorry, Rick. But what I want to do is I'm going to do another test this week. I'm going to run bull or bear. I have the same search set up in bear called credit spreads, I believe. Again, basic criteria, what's important to me. We've got your time frame. Want a minimum net credit. Want a good minimum return. And the net credits are mostly higher than this because of the 1% return. And I want that 80% probability. Usually I go 85, but I'm giving some breath for the weekly or the daily spreads, the 0 day to expiration spreads after the market move. And of course, you can adjust your strike difference any way you want to. depending if you're looking, and this is just SPX. You could use it against the other indexes that offer daily options, the ETFs that offer daily options as well, but this is just against the SPX series. Real quick, I've got my saved search here. We saved it in PowerOptions. We're looking at SPX 0-day. I'm going to go ahead and run a test. Now, this is going to take a little bit of time, Rick, for each one, because right now what we're doing at the end of the day is we're loading all of the historical data as a snapshot from the close of business today into the historical database tables. Our database of historical data goes back about 6.5, 7 years. So I'm going to interact with that table, and I'm going to tell it that what happened on Monday, but this would, let's go Tuesday. Let's go Monday. So on the 19th, I'm going to run a search, and this would have been a close of day on the 19th prior to Tuesday's open. And we're going to use our SPX 0-day search. Now, we've been bullish. And of course, the market sentiment tool told us that a week ago. We were in the bullish buy. We've been neutral since. So I'm still holding that bullish bias based on that, which is why I'm using the bull put spreads. But we have seen fluctuations this week. Not extreme, but we have seen fluctuations. So it's running, and it's going to take some time. And then what we're going to do is we're just going to take a look at what would have happened if we opened 0 SPX day spreads on the close of the 19th for Tuesday's open. Now, while we're doing that, I'm going to go ahead and pause the screen. All right, no, there we go. All right, so what do we know that we have? With SPX at 56.08 on Monday the 19th's close, we have options of the 55.75 strike versus the 55.70, a good 5-point spread, net credit of 68 cents. So we're looking at a 15.6% return. Some of our lower returns, still an 88, 83% probability. Now we're going to go ahead and calculate the group results of the top 15. Again, historical results have, historical results, of course, are no indication of future progress, but we're just going to take a look here in the scenario. There we go. And of course, in that scenario, we had 30 out of 30. We only would have taken one, naturally, Rick, maybe two, but we probably wouldn't have done one. But averaged an 8.5% return, but SPX was down 0.2% that day. Okay, that's pretty good. Let's go to the 20th. Let's see what happens. And again, the argument is, well, if the SPX and QQQ were only off by 0.2%, couldn't you have done better with an iron condor? And again, it was moving. That one was a low fluctuation, but we've seen how the market has been moving. I don't want to step in front of the freight train of that movement. Since we saw the bullish buys when we were at 51, we're already back up to 56, right? Didn't want to necessarily see that. So this one worked out well. We're going to run the search again. I'm sorry. We're just going to do a couple of these to see how they panned out, Rick. And let's see here. Now the good comment comes in from Jim. Jim says, well, were any of these spreads threatened at any time? And I apologize that I can't show that because our historical data is just end of day. We're terabytes into data here. Okay. And the problem is, okay, so here's the down day. And, even though it was down, we would have opened here. This would have been on Tuesday. We would have opened positions here. And for Wednesday's open, let's calculate those group results. Sorry, Jim. But if I was doing a 2-week trade, we could analyze the trade and I could see specifically if the spread was threatened at any time. But since it's end of day data, I don't have intraday data. I can't tell you where it would have been, Okay. So here we go again. Another 30 out of 30 with 9.9%. Of course, the market ended up. Even though it was down 0.2% the day before, that was that downward movement of 11.13 we saw on SPX.